Women who invest consistently from age 25 outperform men with equivalent portfolios by an average of 0.4% annually. Vanguard ran the numbers. Fidelity confirmed it. And yet, women hold 40% less in retirement savings than men by the time they reach 65. Sit with that for a second. Not because women invest worse. Because structurally, fewer women were ever brought into the conversation. The financial media wasn't built for you. The language wasn't built for you. The products weren't designed with your reality in mind, your longer life expectancy, your higher probability of taking career breaks, your statistical likelihood of managing household finances alone. So here's what this video is actually about. Not a checklist, not a feel-good list of things you're already doing. It's a diagnostic. 7 specific behavioral markers that signal you're already operating above the noise. 2 things to hold on to. First, the most dangerous investing mistake isn't the one you know about. It's the one the system never warned you existed. Second, one of these 7 signs has a hidden dimension that almost no one discusses openly, and it will reframe how you see the next 20 years of your financial life. Here's what mainstream financial media tells women. Cut your coffee. Save a little each month. Stay conservative. Stay safe. Here's a passive fund. Here's a budget template. Meanwhile, institutional capital is making asymmetric bets on macroeconomic trends, using behavioral finance to understand how emotional cycles drive price movements, and systematically acquiring assets that appreciate across generations. There's a reason the advice given to retail investors sounds different from what institutional investors actually do. It's because a financially literate, strategically independent investor is a less profitable customer. The 7 signs in this video are the behavioral traits smart money shares, not personality traits, decision-making patterns. And if you're already doing some of them, you're not lucky. You've built a relationship with money that the majority of investors, men included, have never developed. Let's go through them. Sign 1. You automate before you think about it. There's a concept in behavioral economics called present bias. Your brain systematically overvalues what's in front of it right now compared to what's coming later. Delayed gratification is a cognitive override. It requires effort. The most powerful investing habit isn't the one requiring the most discipline. It's the one that removes the need for discipline entirely, automating a fixed amount that leaves your account before you have a chance to interact with it. You're not relying on willpower. You're using system design to override present bias. And the compounding math here isn't subtle. A woman who begins investing $500 per month at 25, at 7% annual return, accumulates approximately $1.3 million by 65. The same woman who waits until 35? Around $600,000. Same contribution rate. 10 years of delay. $700,000 of difference. But here's what most people miss. Women statistically take more career breaks than men, for caregiving, for maternity, for relocation. Every break that interrupts automated investing doesn't just pause contributions, it interrupts compounding. The real cost isn't the months you didn't invest, it's the decades of growth those months would have generated. This is the structural reality financial advisors rarely walk women through. Automating your investments and protecting them through career transitions isn't just a good habit. It's financial self-protection the system wasn't designed to hand you. Sign 2. You ask what something is worth, not just what it costs. Here's a question almost no retail investor asks. Not what does this cost, but what is this actually worth? Price is the number on the screen. Value is the fundamental economic reality behind it. A stock at $800 might be one of the cheapest assets in the market if the company generates $20 billion in annual free cash flow. A stock at $3 might be drastically overvalued with no earnings path and a shrinking customer base. But when prices are moving and social media is generating noise, most investors conflate price movement with value change. A stock dropping 20% doesn't mean something fundamentally broke. Neither the drop nor the rise is necessarily a reflection of true value. Benjamin Graham, who taught Warren Buffett, called this the difference between investment and speculation. Everything driven by price signals rather than value analysis is speculation dressed up as investing. If you've trained yourself to ask, how does this business make money? And could it still do that in 10 years? You're practicing the discipline that separates long-term wealth builders from long-term loss chasers. In periods of market volatility, price and value diverge most dramatically. Volatility isn't a threat to the investor who understands value. It's the environment where the best opportunities appear. Sign 3. You don't sell when it hurts. Dalbar's annual quantitative analysis of investor behavior has run for over 30 years. The finding is always the same. The average equity investor significantly underperforms the index, not because of bad picks or bad timing, but because of emotional sell decisions at exactly the wrong moment. When markets dropped in early 2020, retail outflows were massive. Investors panicked. They sold. And then the market staged one of the most rapid recoveries ever recorded. The investors who sold locked in their losses permanently. The investors who held, or bought more, captured the entire recovery. The question isn't whether you feel fear when markets drop. Every rational investor does. The question is what you do with that fear. Do you treat it as a signal requiring immediate action, or as information to be examined and then consciously set aside? When your portfolio drops, the question isn't what is happening to my money. It's what is actually happening in the underlying businesses I own. If those companies are still generating revenue, still growing, then the drop isn't a business event. It's a price event. Price events are temporary. Business fundamentals determine long-term returns. If you've built the capacity to observe your emotional response without being governed by it, that psychological infrastructure is worth more than any investment strategy you could ever adopt. Signs 1 through 3 are about internal architecture, habits, emotional frameworks. Signs 4 through 7 are about how you position yourself within a financial system that wasn't originally designed for your participation. And sign 6 has a dimension mainstream financial media has almost never communicated clearly to women. Sign 4. You diversify with intention, not anxiety. Diversification is one of the most cited principles in investing, and one of the most misapplied. Most retail investors practice it like this: buy a lot of different things, own many funds, spread across many platforms. The logic: if everything is everywhere, nothing can really collapse. But what that actually produces is overlapping exposure, higher fees, decision fatigue, and a portfolio so diluted that even excellent performance barely moves the needle. Peter Lynch called this diversification, diversifying so broadly that you eliminate both risk and reward simultaneously. True diversification is about correlation. Assets that are genuinely diversified move differently under the same economic conditions. Stocks and bonds historically have low correlation. Geographic diversification protects when one region underperforms. Asset class diversification, equities, real estate, fixed income, provides structural balance across different economic cycles. If you've thought carefully about why each piece of your portfolio is there, what role it plays, what it protects against, you're practicing intentional diversification. That's a completely different discipline from anxiety-driven spreading. Sign 5. You know exactly what you're paying. Here's a number that should make you uncomfortable. $100,000 invested at 7% annual return over 30 years becomes approximately $760,000 in a low-cost index fund charging 0.1% annually in fees. The same $100,000 in a fund charging 1.5% annually, a fee that sounds negligible, grows to approximately $430,000. $330,000. Gone. Not to market underperformance, not to bad decisions, to fees. To a number so small it barely registers when you sign the paperwork. This is the silent wealth drain the financial services industry has been very good at making invisible. Fees aren't charged as a lump sum, they're shaved off gradually, as a percentage of assets, before the return number you see is ever calculated. And women are disproportionately affected. Research from the National Bureau of Economic Research shows women are more frequently steered toward actively managed, higher-fee products than men with equivalent risk profiles. Know your expense ratios. Know whether your advisor is a fiduciary, legally obligated to act in your interest, or a broker who only needs to recommend products that are suitable, not necessarily optimal. That distinction is not semantic. It is financial. Sign 6. You have a thesis, and you protect it from noise. For decades, the dominant narrative around women and investing centered on caution, on risk aversion, on the idea that women are naturally more conservative investors, as if that were a limitation. But the research tells a more nuanced story. Studies from Warwick Business School, Fidelity, and Vanguard consistently show that women tend to trade less frequently, hold positions longer, and let their thesis play out. In markets where patience is rewarded, which is to say all long-term markets, those behaviors generate superior returns. What gets labeled as risk aversion is often conviction, the discipline of not abandoning a well-reasoned position because the market moved against it for a quarter. Your thesis doesn't need to be complex. It needs to be yours. And you need to be able to defend it, not to anyone else, but to yourself when the market challenges it. Do you believe structural trends like aging populations, energy transition, or digital infrastructure will generate durable returns over the next 2 decades? Then a bad quarter in one of those sectors is data, not a verdict. The financial media has very little power over an investor who has already decided what she believes. Sign 7. You treat your financial education as a compounding asset. Every financial skill you develop, every concept you understand, every framework you internalize compounds for the rest of your life. Financial literacy isn't a fixed state. It's an asset, one that appreciates when you invest in it consistently and depreciates when neglected. The investor who spends 30 minutes a week learning how markets work, how macro forces affect her portfolio, how to read a balance sheet, that investor is building a capability that generates returns across every financial decision she makes for decades. Financial knowledge doesn't just improve returns, it reduces the probability of catastrophic mistakes and gives you the foundation to not be manipulated by products or advisors who don't have your interests at the center. Women have been systematically excluded from financial knowledge transfer, not universally, not always intentionally, but structurally. The dinner table conversations about business and investing, women were often not at that table. But that is changing, and knowledge has no gatekeepers anymore. Every serious investor who commits to building financial intelligence is closing a gap that was centuries in the making. Women who invest consistently outperform, and yet a structural gap remains. That gap isn't a reflection of investing capability. It's a reflection of historical access to information, to conversations that treated you as a financial decision maker. 7 signs you're on the right side of that gap. You invest before lifestyle absorbs your capital. You think about value as distinct from price. You've built emotional architecture that doesn't let fear override strategy. You diversify with intention. You understand your costs. You have a thesis and protect it from noise. And you treat your financial intelligence as a compounding asset. These aren't personality traits. They're learnable, buildable behaviors. Every one of them compounds over time. We're entering a period of significant macroeconomic transition, interest rate cycles shifting, AI restructuring entire industries, demographic waves reshaping healthcare, real estate, and social systems simultaneously. The investors who navigate that well will be the ones who understand not just what to own, but why. The question isn't whether you're smart enough to be one of those investors. The research already answered that. Are you building for the world that's coming, or the one that already passed?